You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host, Sam Ball. This week on The Investor Way, we have Frasers, Ashtead, DS Smith, Baltic Classifieds Group, Moonpig, and our US company of the week is Brown-Forman, makers of Jack Daniels. Sam, shall I kick us up with Frasers?
Absolutely.
So, formerly Sports Direct and owners of brands like Jack Wills, Game, Evan Cycles, Everlast, Van Mildert, House of Fraser, Slazenger, a lot of those old high street brands. They had their half-year results out last week, with first half revenue up 12.7% to £2.6 billion, largely as a result of acquisitions. If these are taken out, revenue grew by 3.9% year on year. Profits before tax were up nearly 39% at £267.1 million, with improving margins and revenue growth in all divisions and continually improving product choice in the core UK business. Alongside a successful growth in flannels and a new store rollout and improved online performance. Meanwhile, net debt increased slightly in the first half, coming in at £499.1 million, up by £8 million, and there was a free cash outflow of £5.4 million as a result of recent acquisitions compared with the £384.5 million inflow last year. The group remains confident in the full-year guidance for full-year underlying profit before tax of between £450 and £500 million, despite the wider macroeconomic environment, and there was no interim dividend announced alongside the results. In terms of the valuation, Frasers has a market cap of £3.8 billion and trades at 11.5 times forward earnings, compared with a 10-year average of 16, and it's not currently paying a dividend. I actually thought these results were fairly decent and think that their elevation strategy with the new freehold flagship stores, premium displays and more digitally integrated model is a good one and something that's worked well at JD. But they do have a lot of tired brands like Jack Wills, House of Fraser, which went under for their own reasons. And it's a very tricky macroeconomic environment out there. I suppose that's why it's trading at not a particularly lofty valuation, 11.5 times forward earnings. And I certainly wouldn't bet against, well, it's not Mike Ashley, but he's there in the background, his family. Probably not one for me at the moment, though. Sam, what are your thoughts on Frasers and these results?
They're all right. That being said, not keeping pace with inflation. A lot of those brands you wouldn't necessarily expect them to. I think your point is a very good one, that basically, there's a reason a lot of these brands went bust. So grouping them all together isn't necessarily a great idea. That being said, there's a lot of recognisable high street brands. The debt's okay. So 500 million of debt, profit before tax for the half of 267 million. I don't know if it's completely the same in the second half, but if it's 500 million of profit before tax a year and 500 million of debt, that's actually more than manageable. I just don't think it's particularly inspiring brands. And there's a lot of other, there's a lot of brands available that you can own that are quite inspiring. Like, I appreciate the completely different businesses, completely different valuations, but I'd much rather own a Nike than a Sports Direct. And I think it applies to quite a few of the brands in there. I mean, it's like Brown-Forman, which we're going to cover later on. That's got some fantastic brands. I'd be very happy to own those. There might be other reasons why I don't buy the business, but it's not like I look at Slazenger and think I want to own that. That's probably how I'd put it. But you're not even getting any income.
It is a cheaper valuation than Nike or Brown-Forman, though.
It's a cheaper brand too, though.
Yeah, well, okay, I'm done defending it. You did own Sports Direct at one point. Would you consider it again?
Probably not.
What made you go for it in the first
It
place?
was, well, I think at that point I was going through a bit of I was much more predisposed to buy value investments at that point, whereas now I've done it enough times that I'm just not interested. That means that I think I did all right on Sports Direct.
Yeah, I was going to say. So I think you bought it around. Was it about the £2.30, £2.70
something,
mark?
but I think I sold it like not too much above £3 to £4. So I'd have been better holding it actually.
Yeah, it had nearly been a two-bagger, and that
it's comfortably beat the FTSE.
That's right.
But
and it would have had I mean, it doesn't have a dividend now, but it did used to.
Yeah, it was about 3% or something. It was pretty decent.
Yeah.
But, over 10, 20 years, do I want to own these brands? The answer is just no.
Okay.
They're certainly not sleep at night brands, are they? You don't sleep soundly at night with like Game and Everlast in your portfolio.
Yeah, knowing that the latest casualty of the high street you're going to be acquiring soon.
Yeah. It's like with Game, like all of this, like the new consoles, you download the games onto them, so it just kills the second-hand market for a lot of them. So it's all right because they sell the older stuff, but as those new consoles become the older consoles, they'll have nothing to sell. I know they started branching out, so it's a bit more like a CEX, but it's not a great position.
Sort of part of the problem, wasn't it, with Game?
Yeah. Right, should we move on to Ashtead?
Yes, go ahead, Sam.
So Ashtead, we have covered them a few times before, but for anyone who doesn't know them, they basically allow you to hire out like heavy industry equipment, so like diggers and stuff like that. So the business model is basically they buy a broad range of equipment from leading manufacturers. They then rent it out to customers on a short-term basis, and then when the equipment gets a bit older, they then sell it in the second-hand market. And that's basically the business model. They're UK listed. They are a UK business, but the bulk of the business is actually in the US and Canada. So their figures are reported in dollars. They have come out with their first half results, and revenue rose 26% to 4.8 billion, ignoring the effect of exchange rates. Growth was driven by rental-only revenue in the US, up 26% to 3 billion, benefiting from both volume and rate improvements. The higher revenue offset the impact of higher costs because of inflation, meaning underlying profit before tax rose 28% to 1.2 billion. Operating costs were up 24% to 2.6 billion. Free cash flow fell from 440 to 154 million, largely as a result of higher ongoing capital expenditure. Group also invested 609 million in 27 bolt-on acquisitions over the half. Net debt, including lease liabilities, rose from 7.2 billion at the beginning of the period to 8.4 billion. The board has announced an interim dividend of 15 cents per share, up 20%. The group spent 207 million on buybacks as part of the 2-year programme, which goes up to 1 billion. Group rental revenue is now expected to be between 18 and 21% higher for the year, up from previous guidance of 15 to 17%. Free cash flow guidance remains unchanged at 300 million. In terms of the valuation, the business trades at a forward PE ratio of 16, and that compares to a 10-year average of 15.3, and the prospective yield is 1.6%. I think the debt's getting slightly uncomfortable. So for the half, underlying profit before tax 1.2 billion. So if we just assume it's 2.4 billion for the full year, debt of 8.4 billion, that's getting on for 4 times that. It's at the upper end of what I would consider the manageable range, and at the start of what I would consider the slightly uncomfortable range. I'm not a huge fan of the business model. I mean, the business model's fine, but it's a low margin industry. It's not an industry I understand very well. I'm not necessarily sure where the growth will come from. Yeah, it's just not for me, unfortunately. But these results are very good. I'll just have a look at the yearly results to see whether they've been up against easy comparatives. No, they haven't. Those results are against pretty tough comparatives. So revenue, 5 years, last 5 full years, so that doesn't include this half year. 3.7 billion up to 4.5, up to 5, 5.9, 7.2, and they're up. What's 26% on that? So fantastic performance, actually, in spite of what I've just said about how I don't find the business particularly attractive. You can't actually knock the results. It's performed very well. It's just not for me. John, what are your thoughts on the results in the business?
Yeah, I would agree with you, Sam. I thought the results were really impressive. I suppose the question is, it's the longer term investment case. it is a low margin business. There is the macroeconomic downturn, and you'd expect something like equipment hire to be impacted. I appreciate things still do seem to be very resilient in the US, but it does have a lot of debt also. Interest rates are creeping up, so it's going to be tighter, and how manageable with those levels creeping up and the higher interest rates, I don't know. Also, if you see falling second-hand values from some of the equipment, that could hit the business pretty hard. It's not cheap either at 16 times forward earnings. I guess it's been putting up the numbers, but if we begin to see that change, it does have a decent way to fall. So it wouldn't be one for me, quite honestly.
I think so. They've invested 609 million in 27 bolt-on acquisitions. I think, because I just can't imagine it's that much of a growth market. As well as good as these figures are, I think they must be buying the growth. That would be my guess. But I just wouldn't spend the time really digging in to find out, because it's not a business I look at and think I really want to know what's going on here. But very, very good performance and good results, in fairness to it.
Yeah.
I just don't I don't really like low margin businesses.
No, fine. Fair enough. On to some more good results, actually. DS Smith, FTSE 250 listed box manufacturer, had their half-year results out last week, with first half revenue up 26% to £4.3 billion, ignoring the effect of exchange rates. This was driven by higher selling prices, which offset a 3% fall in volumes as the market weakened. Underlying operating profit was up 49% to £418 million, again excluding the effect of exchange rates, with higher revenue offsetting a 26% rise in operating costs as a result of inflationary pressures, supply chain issues, and general availability. Free cash flow increased significantly to £494 million from £188 million last year, with improved profitability. Net debt fell by around £400 million to £1.1 billion. Management stressed that the outlook was challenging, but maintained that the second half performance is going to be in line with the first. In terms of valuation, DS Smith has a market cap of £4.3 billion and trades at 8.5 times forward earnings, compared with a 10-year average of 12 and yields 5.5%. I thought these results were really excellent, particularly where we find ourselves in the cycle and the structural trend towards e-commerce and away from plastic packaging, and these all being supportive of DS Smith's model. I suppose the input costs are really where the group comes under pressure, with both paper prices and energy costs, but this is being successfully offset, and the group's paying its debt down, which is now just 1 times earnings before, just 1 times EBITDA, as well as maintaining a healthy 5.5% dividend. It's certainly very tempting. I know we've said it quite a lot of times, and it would be going on my watch list. Again, it's not a particularly exciting business, but definitely something that's less volatile than the e-commerce companies it trades on the back of. Sam, what are your thoughts on DS Smith and these latest results?
I think they're really good results, and they're on the back of, again, similar to Ashtead, they're on the back of very good figures. If you look at the figures for DS Smith over the last 5 years, revenue's gone from 5.5 billion, 6.1, 6, 5.9. Last year it jumped to 7.2, and then it's posting growth of 26% on top of that. As well, that's on a 3% drop in volumes. I mean, I didn't realise it had that much pricing power. I mean, it's like a tobacco company, that, isn't it? I think the valuation is very good for the figures you are getting. I think, forward P of 8.5, dividend yield of 5.5%. Like you say, it's on the back of these e-commerce trends. I really like it. The only thing I don't like is the management strategy of they're trying to decrease the proportion of the paper they make in-house. I guess from an investment perspective, I sort of understand it because it makes the business easier to predict and not as much at the mercy of commodity prices. But I think from a business perspective, I don't know why you wouldn't want that vertical integration. I don't like that strategy. But you can't really knock these results. They are fantastic, especially given the environment we're in and on a drop of volumes. But no, I think of the times, I think it's always got a fairly decent review from us, DS Smith. But I think this is, of the times we've covered it, this is probably the best we've seen it. And I think we've seen it before when it's been very, very cheap and a very good business, but it's not been putting up these kinds of results as well as being very cheap. And the price hasn't really changed.
Yeah,
anything,
which
it's
is
come
surprising.
down.
I suppose it's what the market's predicting about where we are in the cycle and how DS Smith is going to be impacted down the line.
A lot, actually. It's gone back up quite a bit since we last covered it. So it had a 52-week low of £2.38. It's at £3.13 now, and that compares to a 52-week high of £4. But I suppose everything's up in the last couple of months, isn't it? So. But no, I like it a lot.
Okay. Right. On to a new company.
Absolutely. We've got a debut on the show, Baltic Classifieds Group. I'm sure this is a business we're all familiar with, so no introduction needed, but I will give you one anyway. So this is from their website. Baltic Classifieds Group is the leading online classifieds group in the Baltics, which owns and operates 12 leading vertical and generalist online classified portals in Estonia, Latvia, and Lithuania. BCG's online classified portfolio comprises 4 business lines: automotive, real estate, jobs and services, and generalist. Of the sites it operates, in the automotive space, Autoplius and Auto24. So that one's so Autoplius LT, that must be, I think, Lithuania. And Auto24 EE, I'm guessing that's Estonia. Both market leaders. Real estate, or maybe it's Latvia, the LT. Doesn't really. Oh no, I think LV is Latvia. Real estate, Arodus.lt, so I think that's Lithuania. That's a market leader. KV.EE, so that's Estonia. That's a market leader. City24 EE, so they've got the second place in Estonia too, and the second place in Latvia. Jobs and services, market leader in Lithuania. Looks like they've got another market leader in Lithuania. GetaPro, Latvian market leader, and Estonian market leader. General, they've got the market leader for all 3. This is a company, it's listed on the FTSE 250, and it only went public, it only went public in June 2021. So this is a new listing, a relatively new listing on the FTSE 250. The results it's put up since coming public, so it's only got 1 year's results. So you've got the comparatives, 30 April 24, and all these figures are in euros. It had revenue of 42 million, and then to 30 April 2022, that grew to 50 million, so about 20%. Operating profit dropped from 15 to 13 million. Net interest dropped from 13 to 11 million. Profit before tax up from 1.78 to 2.44 million. So, upon looking at this, before we jump into the results, my initial reaction was this could actually be potentially quite interesting, just because it's got these market-leading websites. And I don't know enough about the websites, it's a problem, but to me it seems like if you're talking about the Baltic Auto Trader and the Baltic under one roof, I would be quite interested in that. So that's what I was hoping going into this. So they have come out with their half-year results. They've highlighted that their biggest portal, Autoplius Lithuania, grew its leadership position versus its closest competitor from 4.4x to 5.6x. Each of their main sites are from 5 to 28 times bigger than the closest competitor. So this thing basically just operates Baltic monopolies, it looks like. So it gets a tick for that. So in the results, revenue grew 19% to 29.8 million euros, and all these figures are in euros, driven by a solid performance in all 4 business lines. Autos was up 19%, real estate was up 18%, jobs and services was up 27%, and generalist was up 13%. EBITDA grew 16% to 22.8 million. and that's an EBITDA margin of 77%. So these are Rightmove and Auto Trader-esque margin. I don't know why they're using EBITDA instead of operating profit, because the operating profit, I prefer it as a metric, and these figures are so impressive that the operating profit is going to be very good as well. Anyway, and they've said that EBITDA margin of 77% is despite significantly higher inflation environment in the Baltics. There were no add-backs in EBITDA in H1 2023. It's very, very rare we get EBITDA without getting adjusted EBITDA. They had 7.4 million of costs which were non-cash and related to historic acquisitions. Those were the only adjustments to the half-year profitability. Reported operating profit for the period was up 5x compared to 2022 during the first half last year, during which the company went public and had one-off IPO-related transactional costs. So the operating profit increased from 2.4 to 14.3 million. Excluding the above-mentioned amortization, our adjusted operating profit grew 16% to 22.4 million. Accordingly, adjusted basic earnings per share grew 31% to 3.8 cents, and basic EPS for the half was 2.3 cents. Cash conversion includes GetAPro asset deal and was 92%. Including GetAPro, cash conversion was maintained at 99%. Net debt fell by 9 million to 57.4 million, and that's down from 66.4 million a year ago. We ended the half with leverage at 1.4x, and that compares to 1.7x a year ago. Operational highlights: traffic to the site averaged 63 million visits per month, meaning the residents in the Baltics visited our site 11 times every month. We maintained a significant leadership position over the nearest competitor for all our largest sites compared to 2022. With Autoplius at 5x, up from 4.4x, the nearest competitor, Auto24 at 28.3x, down from 32x, Arudis at 26.7x, down from 29x, Skelbiu at 18.4x, down from 19.7x, KV plus City24 in Estonia at 16.7x, up from 11.9x, and CV Banks at 8.4x, which is about flat. It was 8.3x last time. We have more real estate brokers, which is up 1%, more automotive dealers up 3%, utilising our sites to advertise, slightly fewer customers in jobs after a record year last year, down 4%, but up 57% compared to 2 years ago. We also have more active ads in automotive, up 17%, real estate up 8%, services up 6%, more listings in generalists, up 3%. Yes, in terms of the revenue split, 36% from auto, 25% real estate, 20% jobs and services, and 19% generalists. So it's quite nicely diversified, actually. Marketing costs are maintained at 1.4x revenue. So clearly this isn't a business that needs to advertise too much. Net debt, this is quite interesting because if you look at the results for the past couple of years, the interest expense is wiping out most of the operating profit. So they had a loan of 84 million at the start of the half, and that's down to 77 million. I think this interest that's wiping away it looks like the net debt must be at quite a high interest rate. The business is growing very well. It's generating a lot of cash. I wouldn't really worry about that. That's going to be very easy to pay off, I think. So it's almost masking how profitable this business is. Yes, in terms of the auto, number of dealers was up 3% to 3,577. Number of ads was up 17% to active ads up 17% to 25,379. Monthly revenue per ad was up 15% to 22 euros. Yeah, I think that's okay. But real estate, number of brokers was up 1% to 4,941. Number of active ads was up 8% to 16,733. And monthly revenue per ad was up 20% to 23 euros. I think that's quite low. Let's work it out per dealer. So the revenue per dealer, that's about £1,400. I think they can get that up quite a bit still. That seems quite low compared to what they're getting. When the monthly revenue per ad for the car is the same as the house, I think one of them, the house is being undercharged there. I think they can get a lot more out of that. Jobs and services, number of customers was down 4%, 2,224. Number of active ads was up 6% to 5,876. And monthly revenue per ad was up 113% to 21 euros. And general number of listings up 3% to 93,365, and revenue per listing up 15% to €7. In terms of the valuation, the business trades at a PE ratio of 31, and since listing, the stock has actually taken a bit of a hammering. It's down 34% in the last year, and it's below the IPO price, which was about £2. It's currently at £1.35. John, what are your thoughts on these results in the business?
I mean, I think it has definitely a lot of potential about it, and it's something I think we probably either capital-like business that we traditionally like on the show. I don't know anything about the market that it's operating in, though, and it's quite pricey. For me, it would require a lot more research, but it has piqued my interest. So I will be looking at it further. And debt, what did you say debt was at, Sam?
So it's about 70 million, something like that, the net debt. Okay. When it's got like 80% of the revenue that comes in turns into cash.
Yeah, absolutely.
That tends to not be much of a problem.
Yeah, no. First time we're covering it, it's what I'm interested in.
I would agree. I didn't want to lead you because I was curious as to what you'd say. Whereas normally I say what I think first. No, this has definitely piqued my curiosity as well. I didn't really know anything about it. I sort of expected it to be newspapers or something. I think if you've got these, I mean, these are obviously strong brands. I know we don't know them, but you can just tell these probably are the right moves and the Auto Traders of the Baltic. It's not helpful that we don't know the brand. If anyone actually does know these brands, and we do have any listeners in the Baltic, we don't have many listeners in the Baltic states though. But if anyone is listening from the Baltic, please do let us know what you think about these brands. But no, I think it looks really interesting. I think it's very, very early. So the market cap, I should have mentioned, is 675 million. So it's about a tenth, well, maybe more like an eighth of the size of Rightmove. Auto Traders are similar size as well, but obviously you'd have to add them together. So it's like 6% of Auto Trader and Rightmove combined. I think it does have a lot of potential. I think it's got a lot of potential to increase prices, especially based on what we have seen from Rightmove and Auto Trader. The debt needs to be kept an eye on, but I'm not really concerned about it. And if anything, I think it's masking the profitability. What I would like to see is a bit more of a track record. But it's on the FTSE 250 now. I think we will be coming back to it every 6 months now. Because if I see this in the list of companies reporting, I'm not going to lie. The only reason it's in this week is what I thought was quite poor. There weren't that many to choose from. Whereas even in a busier week, I'd probably pick it out now. Having seen this, I would be keen to follow this for a few more halves and see how it gets on.
Yeah, no, absolutely. I would agree with you there. Okay. On to Moonpig, the online cards company. They had their half-year results out this week with revenue up 0.1% year-on-year to £143 million. And compared with pre-pandemic levels, that's 115% up. Adjusted EBITDA fell to £34.6 million from £35 million last year, representing a 5% fall to £103 million at Moonpig and an 18% fall at Greets to £24 million. This is, however, up 130% compared with pre-pandemic levels. Gross margin stood at 54.1%, representing a 511 basis point rise year-on-year. Total orders, however, decreased by 13%, which the group attributes to the COVID boost in the prior year and the UK card orders being impacted by the Royal Mail strikes. There was a 6% increase in average order value to £7.80, with pricing increased and more targeted promotions. Moreover, demand for gifting was shifting to lower price points. The revenue growth that underpinned the results came from existing customers, up 5% to £118 million, excluding the £14 million COVID boost, which the group describes as large and loyal, allowing for a reduced marketing spend whilst investing in the brands and a focus on activity around peak trading periods. Numbers of new customers fell by 7%. Concerningly, gifting via Moonpig and Greets was down 6% to £56 million. Post the £12 million acquisition in July, the experiences sales grew by 19% to £18 million. Net debt stood at £208.8 million, which equates to nearly 2.5 times adjusted EBITDA, and the group is aiming to deleverage to between 1.9 and 2 times in the second half. In terms of outlook, the group have reiterated that trading conditions are going to become more challenging, but that full year 23 revenue remains unchanged at £320 million and remain confident in the structural growth of the sector. In terms of valuation, Moonpig has a market cap of £407 million and trades at 18 times earnings. I thought these results were a bit disappointing. I know they're up against strong numbers and strong comparators from last year, particularly as we were still having restrictions and lockdowns. I think I expected a bit more from Moonpig, and overall thought that they didn't really deliver. Net debt is on the higher side too, and I don't know, with the downturn, how much people are going to be cutting back, particularly with the prices going up on Moonpig. And on those, well, I know experiences have grown, but on some of the gifting that comes with it too, which I think it will hurt it. And it's not a cheap business either. Sam, you liked it last time, and the capital light nature of the business. What are your thoughts on these results and where we're going from here with Moonpig?
Yeah, I don't think. I mean, these results in isolation are not great, but I think if they've maintained revenue forecast at 320 million, that is higher than last year. So they are still. So last year revenue was 304 million. We don't know how that's going to feature into operating profits. I do like it. I think, having followed it for a while now, I think it's actually a better business than I first gave it credit for. One concern, well, I have a couple concerns with it. The revenue in 2020 was 173 million, and then it got a massive spike to 378 in COVID, and then that's dropped to 304. So it's lost some of the COVID customers, but most of them have stayed. If it's 320 this year, that's almost double what it was pre-COVID. But I would maybe have concerns about the growth. That being said, they are getting into gifts and stuff, which I do like. I think it's a very natural add-on when you send in a card. It's like, oh, do you want to add in some chocolates or something? I do like that. I think there is some good optionality with it. But in terms of the people that are aware of Moonpig now, because of the pandemic, I don't know how much. A lot of growth has been pulled forward, but I don't know how much growth is actually remaining. You might reactivate some of the pandemic customers, but I don't know if we're getting to a point where we've reached saturation, and the debt is quite high. They've got negative equity on the balance sheet, which is not fantastic, and interest rates are going up, which is not the best combination, especially when profits are going down. So yeah, it's an interesting business. I like following it. I think there is a good business in there, but I wouldn't invest in it. I think there are a lot of risks that aren't necessarily priced in either, because it's quite expensive, isn't it? What did you say the PE was?
18 times earnings. Yeah,
that's quite pricey for a business with these issues. I think it might be on reduced earnings, and it's actually, the stock's down 68% in the last 12 months.
Yeah.
So yeah, 18 times reduced earnings, but I think it's a business with a lot of potential, but also a lot of risks. For me, it would just be a pass, but I'd quite happily come back and visit it again and again, because I do like checking in on it, and I do think it's an interesting business.
No, fair enough. Okay, on to what is arguably the highest quality business of the week, Brown-Forman.
Oh, I don't know if Mike Ashley would agree with you, but yes, Brown-Forman making its debut on the show. A lot of the US companies are debuts, but this one's actually quite a surprising debut, I think, given John's known love of consumer goods brands. I am actually surprised this is the first time we've covered it. Brown-Forman, easier to think of it as it's almost like an American Diageo, really, although it is about half the size of Diageo. I'll just go through their brands to start with. So it's a drinks maker, and their brands include Jack Daniel's, which is probably their most famous brand, one of the most famous brands in the world, actually. Herradura tequila, Woodford Reserve bourbon whiskey, Old Forester bourbon whiskey, Finlandia vodka, Benriach whiskey, Ford's gin. They have come out with their half-year results, and they've reported net sales, and obviously it'll be in dollars, by the way, and they've reported a net sales increase of 11% to $2.1 billion, and that's up 17% on an organic basis. Reported net sales growth was negatively impacted by 6 percentage points of foreign currency exchange. In the first half, reported operating income increased 8% to $656 million, and that's up 19% on an organic basis, and diluted earnings per share increased 11% to 99 cents. Portfolio growth was led by Jack Daniel's Tennessee Whiskey, with reported net sales growth of 9%, and that's 18% organic. Sustained double-digit growth of Woodford Reserve, with reported net sales growth of 39%, and that's 40% organic. And ready-to-drinks, with double-digit reported net sales growth of 14%, and that's 20% organic, propelled by Jack Daniel's ready-to-drink and New Mix. Reported gross margin contracted 130 basis points, driven by inflation, supply chain disruption costs, and foreign exchange. Reported advertising expense increased 19%, and that's 25% organic. The Jack Daniel's family brands reported net sales growth of 9%, 17% organic, which was fueled by Jack Daniel's Tennessee Whiskey. Premium bourbons, propelled by Woodford Reserve and Old Forester, delivered 39% reported net sales growth, 40% organic, driven by higher volumes in the US, which included an estimated net increase in distributor inventories as glass supply constraints ease. Ready-to-drinks delivered double-digit reported net sales growth, driven by consumer preference for convenience and flavour. Jack Daniel's ready-to-drinks and ready-to-pours grew reported net sales 9%, 15% organic, led by Australia and Germany, partially offset by the negative effect of foreign exchange. New Mix delivered 48% reported net sales growth, 46% organic, fueled by Mexico, with market share gains in the ready-to-drink category. Reported net sales for the tequila portfolio increased 10%, 11% organic, led by El Jimador and Herradura. El Jimador grew reported net sales 16%, 18% organic, and Herradura increased reported net sales 9%, 9% organic, driven by volumetric growth in the US. Herradura's reported net sales were positively impacted by an estimated net increase in distributor inventories as supply constraints eased. Reported net sales in the US grew 11%. Developed international markets experienced strong consumer demand as reported net sales increased 3%, and that's 14% organic. So they've really been hit by exchange rates there. Emerging markets reported net sales increases of 14%, and that's 27% organic, led by the growth of Jack Daniel's Tennessee Whiskey in Brazil and Sub-Saharan Africa, as well as sustained double-digit growth in Mexico, fueled by New Mix. Reported gross profit increased 8%, 17% organic. Gross margin contracted 130 basis points to 58.8%, driven by the impact of inflation on input costs, costs related to supply chain disruptions, and the negative effect of foreign exchange. This decline was partially offset by favourable price mix and removal of EU and UK tariffs on American whiskey. Reported advertising expense grew 19%, 25% organic, driven by increased investment in the US to support Jack Daniel's Tennessee Whiskey. Herradura, the launch of Jack Daniel's Bonded series, and Woodford Reserve. Reported selling, general and admin expenses increased 7%, 11% organic, largely driven by higher compensation-related expenses. And in the 2023 outlook, they said that organic net sales growth is expected to be in the high single-digit range. Projected reported gross margin should be consistent with the first half. They anticipate high single-digit organic operating income growth, and they expect the effective tax rate to be 22 to 23%. And capital expenditures plan to be in the range of 192 to 210 million. In terms of the valuation, the business trades at a market cap of 32.3 billion and has a PE ratio of 36.56. It looks like Diageo's is about 26 at the minute, and we complain, well, we don't complain, but we normally comment that that's quite pricey. My view is this is a fantastic business. It's got some fantastic brands. It's putting up fantastic results, but I'm not sure these results are any better than Diageo's. Diageo, for the last couple of years, has put up absolutely fantastic results as well, and you can get Diageo at 26 times earnings compared to 36 for Brown-Forman. So I'm not sure, and that's forgetting how expensive the dollar is as well. Very, very good business, but in terms of the stock, I'm not sure why you'd pick this over Diageo. John, what are your thoughts as a Diageo shareholder?
I'm very comfortable holding Diageo and potentially adding to Diageo, but yeah, like you say, it's all about the valuation. It's a fantastic company and it's delivering great numbers, but it's just the pricing of it. And particularly, as you say, as a UK investor paying up in the dollar, it's just so expensive. And I do think Diageo is actually a better business and overall has better brands, better portfolio. So I'd, even if they were the same price, I'd probably go for Diageo, to be honest.
Not thinking of a switch then?
No, absolutely not. I'd potentially like to own it as well, but not at these prices.
No, definitely not. So then, of the 6 businesses we've covered this week, Frasers, Ashtead, DS Smith, Baltic Classifieds Group, Moonpig and Brown-Forman, if you had to buy one, which one would it be?
I would probably go with DS Smith. I think it's a quality business. It's on a structural growth trend and it's not expensive to buy and it's got a healthy dividend. Valuation aside, but I mean, I love Brown-Forman, but 36 times earnings, I just couldn't pay up for that.
I think I'd probably take a punt on Baltic Classifieds Group.
Okay.
But in reality, if I was going to buy it, I would need to do a lot more digging because I do not understand the business anywhere near enough at the minute. I don't really know any of the websites.
Yeah.
But no, that did look quite interesting.
You can get the research done before fantasy portfolio is updated.
Absolutely. Not long now.
Have you had a look at any of the results?
I have not.
No. Okay.
No spoilers.
No.
There's been a bit of a rally the last couple of months, so we'll see how we've done. But the Bitcoin's not done well, though. That's absolutely been hammered. But that was only
allocation or 2.5%?
It was 2.5%, so it's not going to make or break. The commodities are probably still doing very well. So anyway, no spoilers.
Yeah. Well, I'm just guessing with some of it, but when we get the numbers up, we'll see.
Absolutely. A couple of weeks away now.
Okay, well, you can get excited for that, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.